Why does it say paper jam when there is no paper jam?
Yeah, that's it. That's exactly what I need. Yeah, give it to me. Come on, you little let's go.
Hey guys, Rafi here from the Endgame Investor, and today we're going to talk about paper.
Paper! Oh, there's never seen paper! Smell it.
Paper or plastic? Paper.
There's a long-standing school of thought in the gold and silver community that paper futures trading is actively used to manipulate prices down. I'm not of this school. Not that I don't think that paper manipulates prices, but I do not think it is a conscious activity. The way it works is like this. Paper contracts represent a certain amount of physical goods. For example, one contract of gold represents 100 ounces, one contract of silver represents 5,000, one contract of oil represents 1,000 barrels, and so on and so forth. Now, the total number of contracts that are traded are way more than the actual physical supply of commodities that are available on planet Earth, at least dug out of the ground and available for consumption. And how is that possible? Because of the way that the system trades, and that is through margin. A trader only has to put down a certain amount, a fraction of the amount of the full value of the contract. Let's say a gold contract is 100 ounces, so the full value of the contract would be 100 ounces times 1,930 whatever dollars it is. And for oil, you only have to put down a certain margin, a certain fraction of the contract value, which means you can afford to buy more contracts than actually exist, than oil or gold or whatever actually exists on planet Earth available for consumption. What is the advantage of margin trading for speculators? It's that if you have, say, one contract of gold that represents 100 ounces, then the multiplying factor for that contract is every dollar that it goes up, you gain $100. And for silver, if silver goes up $1, you gain $5,000 without having to put down the full value of the contract. So you get much more leverage with lower margin requirements. If you only have to put down, say, 20%, you have a 5x factor for leverage for every tick that the contract moves, even though you didn't put down all the money of the value of the contract. Again, we see that it's leverage that is corrupting the system. And it is the margin itself that is making the supply of the commodity represented by the paper look higher than it actually is by the factor of the margin, the fractional reserve requirements that are required to trade these contracts. If there is no margin option and you simply have to put down the full value of the contract that you are trading, then there cannot be a difference between the paper supply and the physical supply. That is the manipulation, the margin system itself, just like it is in the fractional reserve banking system, just like it is in every feature of every fractional reserve system that is inherently inflationary by the leverage that it encourages. And this is the same mechanism as any fractional reserve system. It's the same with bank accounts. You only have to hold a fraction, a margin of your existing dollars, which is why when the system does break and too many people try to access whatever good is underneath the margin, whether it be dollar bills in a bank account or oil in a contract form or gold in contracts or nickel or whatever, there is a violent repricing of paper in terms of physical reality, which is exactly what happened in the nickel situation on the London Metal Exchange. Producers of these real commodities get their price signals through the paper markets, and as long as traders and speculators do not all call for delivery of their physical goods all at the same time, those prices guide the production and consumption process on planet Earth. And so you have a situation where real commodities are a lot cheaper on paper, which pulls the real physical prices way down. But eventually, physical reality reasserts itself, and you have a violent swing upward in short squeezes of people who are short contracts are offering to sell a certain amount of goods which do not exist and they do not have it. It's the same with banks, which say that they hold a certain amount of dollars when they do not, which is why every fractional reserve system collapses and every inflationary system is built upon a fractional reserve system. Ultimately, the dollar is still a gold substitute. And so the amount of gold, paper gold, traded on the COMEX or in London, everywhere on planet Earth, is much more than the actual gold supply. Now we are seeing in one area where there was a real short squeeze and people who offered to sell nickel short but did not have it got margin calls, and quickly the price of nickel shot up closer to where physical reality would bring it, except that the London Metal Exchange bailed out the hedge funds and the commodity traders that were going bankrupt because of this. And because that happened, traders are now abandoning the London Metal Exchange. And what that is causing is a fall in open interest, to fall in the amount of traders that are opening contracts, to fall in the amount of contracts, and another rise in the price of nickel. This is from Bloomberg, syndicated by Yahoo. Here you have the graph of open interest in nickel, meaning the amount of contracts that are open. All of these are way more nickel than actually exists on Earth. Since 2012, it has been falling from about 2.9 million or 3 million to about 1.6 million now. Bloomberg, traders and investors are rapidly cutting exposure to the London Metal Exchange after this month's nickel market chaos, driving open interest to a 15-year low and leaving key metals exposed to wild price swings as liquidity shrivels. The number of open positions across the LME's 6 main metals fell more than 8% in the 2 weeks after the exchange suspended trading in nickel and canceled billions of dollars worth of transactions on March 8th. Investors have queued up to unwind their nickel positions since the market reopened, and the chaos has spilled over into other markets due with aluminum and zinc exposure dropping sharply. So now that traders understand that if they go long and the situation is not to the LME's liking, their trades can simply be canceled. They are closing their positions, and the amount of paper trading over physical reality is starting to shrink. But this is not confined to the LME. Here's a chart of 28 commodities and their open interest over the last 15 years, plotted against the price moves in the commodity index, the GNX commodity index, and you'll see that something has changed starting in 2021. Top we have the GNX GSCI S&P commodity index. This is an index weighted towards production, so the most produced commodities are weighted the highest, and that is oil. And here on the bottom, you have total open interest for 28 commodities, including energy, metals, and agriculture. In a deflationary scenario, 2008, there was a peak in open interest, the amount of contracts open, which fell along with the price into the 2009 bottom. In the second rectangle here, you see there was a collapse in the price of the GNX index with open interest. So as open interest fell, as traders closed their positions, they were closing out because they were chased out and they were having losses. Same happened in 2020. There was a peak in open interest here just before the 2020 lockdowns, and then a collapse in price with open interest. But something serious has changed since the start of 2021, and that is this rectangle. Here we saw a peak in open interest in the beginning of 2021, and open interest has been falling and falling consistently since then as the prices of commodities have risen more and more and more, basically more than doubled since the beginning of 2021. So basically we are now seeing the opposite of what we usually see. We usually see falling price with falling open interest. Now we're seeing rising price with falling open interest, which means that trader shorts are getting squeezed out of their positions, and they are having to close their positions at a loss. And these contracts are being closed out with nothing being delivered. Positions are being canceled, and the paper supply over the physical supply of different commodities is starting to go closer to 1-to-1. It's not anywhere near there yet, but that's where it is headed. And if we zoom in on what has happened the past year and a half, this is what we see. This is the price of the GNX, and this on the bottom is open interest, especially since February of 2022. We've seen a massive short squeeze in all forms of commodities, energy, metals, and agriculture. We've seen the price get squeezed higher as open interest falls to a new low of around 10.3 million across markets. So what I'm saying is there is really no such thing as manipulation or a conspiracy to manipulate prices lower. There is a system of fractional reserve of a supply of commodities that is represented through paper that does not exist, and that sets prices much lower by making financiers believe that there is more supply than actually exists in the world. But as the fractional reserve system breaks, physical reality moves in tandem with paper reality, and the two go back into synchronization. In an ideal world, there would be no fractional reserve. There would be no margin trading in futures. Each contract would represent an actual physical supply that exists, which wouldn't put banks in danger, which wouldn't put traders in danger, would bring the prices for physical commodities a lot higher than they are now. And that would end the inflationary system, bring prices back to where they will be. And this will happen, the last of which will be gold and silver, and that will be the end of the fiat monetary system, which feeds itself through fractional reserve, which is the source of the entire illusion of fiat money by artificially inflating the supply of physical commodities that do not exist. It is coming to an end, which is why you need physical gold and silver and not just paper gold and silver, with which you might be able to make some dollars, but the dollars themselves won't be worth much, and only the physical will get you what you need to buy.
Back up in your head with the resurrection.
This is Rafi of the Endgame Investor. If you enjoyed this video, you can sign up for a 2-week free trial of the Endgame Investor to see what I'm doing to prepare, and I think it is coming in the next few months this year. Or you can become my patron on Patreon, where I give a biblical commentary on the ideas of liberty and how they relate to a biblical conception of economics. And I wish you all a good week, and God bless.